SISIP WebEx webinar today, and today our topic is called Credit and Debt Management, and I just want to thank everyone for joining us and listening in on our topic that hopefully will be educational and provide you with a little bit of guidance with your financial future. Today we're going to go through about 10 to 15 slides. I'm going to tell you a little bit about myself, and then we'll get right into the presentation. So my name is Denise Reed, and I'm a financial counselor with SISIP in Trenton, Ontario. I've been here for 8 years, working with the military community, previously living in Nova Scotia for 18 years, and then my husband was transferred to Trenton. And then I was lucky enough to start employment with SISIP and help lots of military members over the last 8 years with their finances. I really enjoy the education component of my job, and that's why I'm participating in this today. So it's a great way to, this is another great way to educate people, which I think is awesome. So I'm going to tell you a little bit about SISIP as well, and a couple of slides there. We are part of Canadian Forces Morale and Welfare Services, and we report right up to the Commodore and then up to the CDS. So within Canadian Forces Morale and Welfare Services, as you can see, our I guess, co-workers, companions can exist to CANX, so CANX is part of that program. Then we have JPSU, and Military Family Services, PSP, and then SISIP. So we all fall under the same umbrella. Within SISIP, we have a vision, and I'd like to just briefly talk about our vision. Our vision is that every member of the CAF community and their family has financial health and security, which is pretty important in today's world. Ensuring that the military is healthy financially certainly helps alleviate a lot of stress and a lot of burden, especially with military members having to transfer all across the country and all around the world. Having your financial house in order is really important. So I'm going to get right into the credit and debt management and a little bit about payday loans, as that's the topic as well. And we're going to talk about, first thing is good debt and bad debt. So I'd like you to think about, before we go into that next slide, if you can think about a good debt example and a bad debt example. So take a few seconds to think about that. I'll give you a hint in that good debt, there's only 2 kinds, and then the rest is going to be all bad. So we'll move into the next slide, and we're going to talk about good debt and bad debt. And as you can see, good debt, as it states there, needs to have value and it needs to have profit in the long run. It's borrowing money that helps you to improve your overall financial health. So when you're taking on good debt, you're anticipating that it's going to help you in the long run. And the 2 types of good debt, so hopefully maybe you've guessed maybe 1 or 2 of them, is a student loan or business loan and a mortgage. So those are the 2 types of good debt. And then the rest is bad debt. So bad debt does not have any value. It loses value almost as soon as you take on that debt. Debt that you cannot repay in a timely manner could become bad debt. So, for instance, an example would be if you were to purchase something on your credit card and you couldn't pay the balance in full when your bill came in, then you have then created a bad debt. So it loses value as soon as you use it. And there's all kinds of different credit that you can use. A credit card is one example. We could also talk about a vehicle as being a bad debt. Now that's one that will have could have a lot of controversy over, because most people find it very difficult to purchase cars with cash. But it's all about the long-term gain of the vehicle. But it is considered on the bad debt side. So when you're taking on debt, we're going to talk about what's called a total debt service ratio, which is the next part of the presentation. And this is a very good tool to have when you're deciding whether to purchase something on credit, whether it's to take on a car loan, whether it's to purchase a home, whether it's to take on credit card debt, whether it's to improve your home on debt. Anything that you're not going to use your own money for, you're going to have to use credit to make those purchases. And so knowing your debt ratio is a really good tool to have. But I'm going to caution you on a few things once we've gone through this debt ratio calculation. So what debt ratio means is how much debt you have compared to your income. So what it says here is that your total debt service ratio should not, and cannot, but sometimes it can, it should not exceed 35 to 40% of your gross income using the following calculation. So when you're learning to, when you're figuring out your debt ratio, you're taking all these payments and you're going to divide it by your gross monthly income. So we can put an example in here of, say, the first thing we have listed here is a total loan and lease payment. So let's just say you have a loan payment of $500 a month. Okay. Oops, sorry. Go back there. Sorry. We're going to look at putting in a lease payment of, say, $500 a month. Then we're going to add in your credit card payment. So let's just say you have a credit card and your payment per month is $100. Okay. And then we have to add in your housing costs. So that would be either if you rent, it would be your rent, or if you own a home, you need to include your mortgage payment, your property taxes, and your heating costs. So let's just say you have a mortgage of $1,000 a month, and that includes your property taxes, for instance. Then we're going to add in, say you're separated and you need to make alimony payments, or you need to make child support payments. And let's just say that it adds up to about $500 a month. Okay. So this is all of your monthly obligations for all of your debt. So you need to include your debt payments and your housing costs and any court-ordered child support payments. So we're going to add all that up, and at the end what we get is a total amount of $2,100 per month. So that's your total monthly payments. Then what you want to do is you want to divide that by your gross monthly income. So your gross income is your income before any taxes are deducted. So let's just say your income per year is $80,000, and that equals per month $6,666. So that's what we'll put on the B line there. So $6,666. Okay, that's $80,000 a year. So divided that by 12 will get us our monthly income, gross. So what you do next is you're going to take A, which is $2,100, and you're going to divide it by B, which is $6,666. And that equates to 31.5%. Okay, so that's your total debt service ratio, equals 31.5%. So when we look at is that healthy or not, well, at the top it says it should not exceed 35%. So we're under the 35%. So it is just one indicator of understanding what your debt ratio is. So if you were today deciding whether you should purchase another vehicle, for instance, and the payment was going to be $300 a month, well, that's going to bring you over the 35%. So that would make it very unhealthy. It's probably close to 40, but it still is very tight. It's going to create a very tight budget for you. So that's debt ratio, and a very, very good thing to have in your back pocket, especially when you're going to make major purchases. So in this case here, we put $1,000 per month for, say, rent. But if you were going to look at going and buying a home that was going to cost you $2,000 a month, then again, your debt ratio is going to be over 35%, possibly over 40%, and that would be causing your budget to be very restrained. So that's a good idea for you to calculate this after the recording to know what your debt ratio is. And that's going to be a moving target. So as life events change throughout your life, then that number is going to change. The next thing we're going to get into is we're going to talk about the different types of credit. And there are all kinds of different types of credit in today's world. It's just, it's changing all the time. And it's not like it was many years ago where probably our grandparents didn't have any credit. But now credit is everywhere. It's around every corner. And I like for you to think about all types of different credit. Credit is when you're borrowing money. So whether it be a credit card, a car loan, and we're going to go into the different types of credit on the next slide. I'm going to talk about a little bit of those different types. So here on this screen we have listed types of credit. So we have listed personal loans, which is probably the first thing you think of. Mortgages, you're borrowing money to buy a home, so that's credit. Credit cards, there's all kinds. Every bank has all kinds of different credit cards. There's so many, it's just unbelievable. Then you have store cards. Store cards would be, say, the Brick, Sears, Leon's. Those are store cards where you can, in most cases, maybe just use it at that store. Walmart cards, all kinds of different store cards. Mobile plans, that's a type of credit. So if you have cell phones, you're borrowing the money on a plan in hopes that you make your payments each month. Another type of credit is utilities. Since all utilities work differently, so some of them you could be using the service, such as your heat or your hydro, and then you're paying it after you've used it. So that's a type of credit. That company is going on the honor system that when they have you use heat or hydro, that you're going to pay your bill when the bill comes in. Then there's always interest-free loans. So some companies, some car dealerships, you'll see interest-free financing where there's no interest for a certain period of time. Some of the things that we don't have listed here, which I think is good to talk about, are deferred payment plans, which sometimes you'll find on these store cards. So deferred payment plans would be like buy now, pay later, and you'll see some of those at the furniture stores where you'll set up a plan and you don't pay until 18 months, and then when the 18 months is due, then you have to make your full payment. Overdraft protection is another type of credit, which is something that's on your bank account, where the bank allows you to go below zero on your bank account for a certain period of time. Very high interest rate type of borrowing. So that's on your bank account. And sometimes that's a good thing to have there, just to make sure that any payments that you have going through your bank account, you want to allow it to go through so that nothing gets returned or no problems caused. And so that's a good thing to have, but if you're using it all the time, then it can become very expensive. Another type of loan could be just a family debt. Lots of people sometimes are borrowing from their families, and so that's a debt. That's a type of credit. Lines of credit through your bank, which is where you're able to borrow, pay it back, and keep borrowing and paying it back, which is sort of like credit cards, works the same way. Student loans, another type of debt we already talked about, that could be a credit as well. So those are, I guess, most of the basic ones. There's probably all kinds of different ones out there that I don't even know about because things change so much. But like loan sharks, that could be just your loan shark down the road who's going to lend you money for a couple of days and charge you a lot of interest to borrow that money. One of the things that is, I guess, I find really prevalent here in Ontario especially, is another type of debt called a payday loan. And that's the one we're going to talk about next. And the payday loan is the highest form of borrowing out there. Probably not compared to your loan shark, but the loan sharks we're just going to say are off the table, off the grid. They're not governed by any particular body. Payday loan companies are governed by the government. They have capped the interest rates on these types of loans to be at no more than 59%. Very high interest rate type of borrowing. So if you don't know what a payday loan is, I'll maybe explain it to you a little bit about what it is. Maybe you can think about that for a few minutes. But this type of borrowing is, in my town that I'm in Trenton, there are 5 different payday loan companies around town. And what I've noticed over the last number of years is that they're now online. So if you need to borrow money very quickly, then it's available for you online now. A payday loan is something that you borrow money with the intention of paying it back on your next payday. So these types of companies prey very much on people who are vulnerable for sure, but prey on people who have a paycheck, and certainly military members fit in that category where you have a guaranteed paycheck every twice a month. So this is where you borrow the money and then you pay it back by your payday. And so what ends up happening is that you're borrowing it for a very short period of time. So in this example right here, we're talking about borrowing $400, and the total is due in 17 days, which is your next paycheck. The fees and interest are $51.28 in this particular example. So total due in 17 days is going to be $451.28. So when you go back to pay that back, you're paying back $400 plus $51 more. So now you're short a substantial amount of money in a very short period of time. So when you take that and you evaluate it over an annual basis, 365 days of the year, it ends up costing 275%. And that's extraordinarily high. So what ends up happening in a lot of these cases when you're borrowing again with these companies is that you end up having to borrow from them again. And that's the cycle that ends up happening with payday loans. It's called the cost of borrowing. It's called the cost of doing business, I guess. And this is what we'll show in the next slide here is the cost of borrowing. So you're borrowing a certain amount of money. There's a certain amount of interest shown on it, and it's going to be for a certain term. And then you're going to have fees associated with it. So although the government has set the interest rates at 59% on payday loans, these companies have fees that's structured in there sometimes as well, and that's what ends up costing so much and end up making the interest rate very high. So it's really important to look at your contracts when you're signing for any type of borrowing, is what kind of fees are in there, how long is it for, what's the interest rate, how much is it going to cost me over the long run. There is, don't think we'll do it on the recording, but I'd like to give you a website, and maybe we can put it in here. It's called FCAC, which is Financial Consumer Agency of Canada. And so it's www.fcac-acfc.gc.ca. And I'm just going to bring it up myself just so I can make sure I guide you to where you can find a case study. And it's called The Effects of Interest. So when you go on to the FCAC website, you're going to go into, just going to bring it up here, called Types of Credit on your left-hand side of the website. As soon as you bring up that website, it's called Types of Credit. Sorry, I'm going to go back a little bit there. On the home page, sorry, Margaret. On the home page, you're going to go to...
Why don't you share it with us, Denise? If you go up to share in the top left-hand side of the screen, and go to web browser.
Perfect.
And then we'll be able to see the website that you're speaking of that talks about types of credit. Wonderful. So she's putting that way you get to see the website as well.
Yep.
There we go. And we go to English or French.
You can choose French as well. So this is the Government of Canada's particular agency falls under the government. There's a wealth of information here about all the documents and head down. And you can go into For Consumers. And we're going to go down to Credit and Loans. And we'll tick on Debt Management. Sorry, I think I might have. Money and finances.
This is such a great resource. There's so many articles and information on.
Yeah, there's all kinds of information here on finances, and I thought I had the path. And now I'm blocking myself. You know what? I know exactly the steps, but can we maybe put it on afterwards, Margaret?
Yes, you know what? We can attach it to this recording so that people can have a direct link to it. Absolutely. Okay. And to stop sharing,
you just. I know the exact.
Excellent. And just to stop sharing, you just bring your mouse right up to the top.
I did have it written down, but I think I might have messed up.
No worries. We'll share that with the recording. So
I can just close this.
Yes, there you go. Perfect. We're back now.
Okay. So in my research, I go into that website all the time to educate myself, and there is a case study there about types of credit, which is really easy to follow and interesting. Okay. So we talked about good debt and bad debt. We talked about interest rates. We talked about payday loans. We talked about types of credit. Talked about the cost of borrowing. Now we're just going to go into a few things to consider when you're looking at borrowing, looking at understanding credit and debt. So credit cards and credit should not be used to supplement income to meet budget shortfalls. So that's really important, that credit cards are not a paycheck. You are borrowing money. So it's not like if you have a $500 credit card limit that's $500 free that you can use and that you can use as cash. Make sure that when you are taking on payments, which we talked about in the debt ratio calculation, that your payments can fit within your budget. So that's one important thing that we stress as financial counselors, is making sure that you have a very good working budget. Because the debt ratio is one thing, but it's your overall budget that determines whether you can afford to take on debt payments or not. Very important, as we talked about, especially when we talk about payday loans there, is to read terms and conditions before signing any contract. So whether it's a payday loan contract, a loan contract, a mortgage contract, a contract potentially with a family member, make sure that you are reading the terms and conditions and understand what it all means. If you borrow responsibly, and it's not to say that this is telling people that we shouldn't borrow money. Ideally, we'd like to not, because it can cause stress and a lot of other problems down the road. But make sure that if you are borrowing, that you're borrowing responsibly, because doing so will help you build a good credit history. Use credit to spend beyond your means will damage that credit. So if you're spending way beyond what you can afford to pay, then you're going to potentially it will have a damaging effect on your credit rating. If you're going to take on debt, pay debt down quickly, as quickly as you can. Research the complete cost. So not just if I'm going to buy a car, it's going to cost me $300 a month. You really want to understand what the full cost of it is. Research it. Make payments in full and on time is really important. This is just a few things I'm adding in here. And ask about discounts if you use cash. So sometimes some companies will pay cash right up front, or it could be a discount potentially. And shop around when you're using credit to borrow. Next slide we're going to go into is ways to reduce temptations, and this is just a few. I have a few more that I'm going to go over as well. But ways to reduce temptations and ways to reduce debt is get rid of extra credit cards. If you have like 3 or 4 credit cards that you're not using, then get rid of them, and that will help reduce your temptation. One thing that I do myself, I have learned over the years, is that I reduce my credit limit. And so what happens a lot of times with credit cards is you'll get letters in the mail that because of your good standing, you can get a credit limit increase. And sometimes that can cause a lot of problems. So what's really best is to not engage in those types of letters if you feel that you're vulnerable to using those limits all the time. So keep your limits reduced will help you reduce temptation. Really, the department store cards, retailer credit cards, they're really expensive. So again, if you can avoid using them, that will help keep your debt down. Another good one that I talk about with my clients all the time is leave home without it. Just don't take it with you. Oftentimes I'll just tell people to keep their credit cards maybe in an ice block in their freezer, and that will reduce the temptation. Set up automatic bill payments so that you don't have to worry about your payments is another way to keep your payments in check. Avoid the buy now, pay later. The ones where you get your product now, but you don't have to pay for 18 months. A lot of times with those types of borrowing, when you, if you don't look at the fine print, is that if you don't pay by the time it's due, you're paying interest right back to the day that you made those purchases, which if it's 18 months and the interest rate is, say, at 30%, that's going to cost you a lot of money. So basically, it's best to save the money now and then make your purchase. So buy now, pay later can cause a lot of problems. Avoid impulse buying. Sleep on it for 24 hours. If you're going to make a major purchase, maybe set a limit. If you're going to make a major purchase that's, say, over $100, that's what your goal is if I purchase anything over $100, I'm going to go think about it for 24 hours before I make that purchase. And a lot of the times, by the time the next day is up, you will have changed your mind and not made that purchase because you determined that perhaps you just didn't need it, that it was really a want. So if you're getting into some credit card debt and it's starting to become maybe a little bit stressful, or it's impeding on your ability to save maybe for future goals, then you're going to want to maybe sit down and look at your budget and find ways to pay it off faster. This next slide is getting into what to do when you're getting into that credit or that debt situation. It doesn't have to be just credit cards. It can be other forms of borrowing, whether it's a line of credit from your bank or whether it's a car loan or a mortgage or student loans. It could be anything that you want to get it done faster so that you can reach your future goals. So one thing we talk about is stop using it. And that's the simple answer, is to stop using it and cut it up. Or like I said, store it or freeze it, as we said previously. That's how you're going to get it paid off. If you're going to keep using it, pay it, use it, that whole cycle, then you will not get it paid off faster. In some cases, you will never get it paid off if you use that cycle. So really important to stop using it. Contact your creditors to inquire about reducing the rates. And that sometimes can be very successful for some people. Maybe you signed up for a credit card years ago that was at, say, 19.99%. And since then, that credit card company maybe has come up with a lower interest rate credit card for the clients. So it doesn't hurt to contact them, or you can even just say that you are having concerns with getting your credit paid down. Is there another way that you could get an interest reduction for maybe a period of time or an ongoing period of time? Sometimes you may need to look at using your savings to pay it off. If you have some savings, and the savings will help get that debt paid down and get you away from the high interest rates, that may be an opportunity to get it paid off faster. Pay high interest rate debts first. That generally is going to work much better for you than paying off the lower interest rates first. So start at the higher and then work your way down. Last but not least, I'd like to suggest that you talk to a trusted financial professional. And that could be your bank, if you trust who you're working with at your bank. It can be a nonprofit organization. There's lots of nonprofit organizations in most communities that will help you get into a program that will get your debt paid off faster. And certainly consult with a SISIP financial counselor who can also help you get your debt paid down faster. All kinds of different tools, all kinds of different programs that we can set up for you. Our program is free. In case you aren't aware, our program is free through SISIP Financial, and our program is unbiased and confidential. So we are not going to be selling you any products. We are not product driven, we are not sales driven. So you're getting an unbiased, free, confidential advice from a SISIP Financial counselor. The last few slides, we're going to go into a little bit about credit history. So this slide tells you a little bit about how your credit history, what is comprised of. So when you use credit to borrow money, those credit people that you're borrowing the money from are going to report to a credit agency. And through that credit agency, and we're going to get into the two different types in a minute, those agencies, they get the information from those credit card companies. So from your bank, credit card company, those department store cards, car loan companies, they're all going to report how you're paying back your debt to credit agencies, and that creates your credit history. And this little grid here, this circle, gives you an idea of what it's comprised of. So it's broken down into 5 different major components that makes up your credit history. So 35% is based on payment history. So if you're making your payments on time, all the time, then that's going to be a pretty big part of your history. So 35%. Amounts owed makes up 30%. So how much you owe is going to make up 30%. And you want to owe, of course, less as possible. Then the last 3 over on the other side is going to be 10% is made up of new credit. So let's just say you bought a car today. That's new credit, and that's going to comprise 10%. And it's going to take a bit of time for that to build up because it's new. 10% is comprised of length of credit history. So the longer your credit history is, the better your credit rating is going to be if you're paying everything on time. Then the last 10% is types of credit used. So this is a really, I find, even though it's only 10%, it's something that people don't understand, is the types of credit they're using. So high interest credit issuers, such as like the Payday loans, or people who charge, companies who charge like 30%. And I'll give you an example of City Financial, which is in every town. You'd know the name, I'm sure. That particular company charges basically, in most cases, about 29 to 30% interest. And they report to the credit bureau. So if you get a loan from them, they're going to report to the credit bureau. And that's the type of credit that is only 10%. But when you're looking at, if that's the type of company you're always going to be borrowing from, even if you're making your payments on time and you keep paying it as you're supposed to, it takes a long time to establish and develop a good credit rating when you're using high interest rate creditors. Because we, as lenders, as myself, we lend money. Major banks lend money. Generally, you're going to those types of places to borrow money because you have poor credit or because you're in a vulnerable position. So really important to pay attention to what types of credit you're using. So that's your credit history, and then what you're going to get through the 2 major companies is going to be a credit score. So you want your credit score to be as high as possible, basically. So here we're giving an example that if your credit score is 730 plus, then you have an excellent credit rating. And if you're in the 700 to 729, you're too good to above average. So the lower your credit score, the poorer your credit is. So in the previous slide, we talked about the variables there, making your payments on time, keeping your debt low, avoiding the high interest rate companies. That's going to help you establish credit. But credit takes time to develop. So if you're just getting a credit card and you're 18 years old, it's going to take a bit of time to grow your credit score. Sometimes probably a year or even longer before you're going to see an excellent credit. You need to take time to establish yourself. So this part here, I wouldn't mind maybe bringing us to a slide show, to a website, Margaret?
Absolutely. So if you go up to share and then web browser.
Yep, web browser. So here I'm going to bring you to a website. I'm going to bring you to Equifax's website, and you can just put in www.equifax.ca. You can even just Google Equifax and you will come to their website. So Margaret?
Hello.
Hi. I think I had a disconnection there.
Yes, no problem. So we were showing the credit score.
Yep. And I'm going to try to bring, just one more time, maybe try to bring up that website. Share, right? Web browser?
That's correct. Yep.
Okay. Maybe because of my connection, that's why I couldn't bring up the website. Okay, so we have the website equifax.ca, and if you scroll down to the bottom, you'll see under Credit Report Assistance, get my free credit file disclosure via Canada Post. So this is what you can do. Any consumer in Canada can do this. You fill out the request form to obtain my free credit report. So you fill that out and you photocopy 2 pieces of identification and you send it into Equifax, and they will send you a free copy of your credit report, which is another great tool to have, that you know what's on your credit report and make sure that everything is accurate. Now you can pay a fee to get your credit score, and that's up to you, but your credit report itself is just all your credit information. You can also do it online with them instantly, and you can get it. You have to pay to get it instantly, but otherwise you can send that off to Equifax and you get a free copy of your credit report.
If you put a request in, Denise, does it change your credit score?
Not when you're obtaining your own credit report. No.
Oh, okay, that's new.
There's only when other creditors are seeking your credit that's going to change your score. But if you're obtaining your own, you can get a free report once a year. That does not affect your credit score. Okay? So next couple of slides, we're going to talk about how to improve your credit score and why. So some of the things we have talked about, we're just going to maybe recap here as to how to improve your credit. So you're starting off with credit, you're building it, and maybe something happens or doesn't happen, doesn't matter whether it's new or old. There's ways to make sure that you're keeping your credit in good standing. So how to improve is you want to pay your bills in full and on time. You want to keep your indebtedness low. So what that means is, when we're talking about the previous slide was about how much debt you have makes up part of your credit rating. The circle grid that we had, I guess circle and grid aren't the same thing, are they? But the circle where we had what comprises your credit history, part of it was amount owed, and that was about 30% amount owed. And so what that second line is saying is that if you're going to run your credit cards right to the limit, or any of your debt right to the limit, I keep saying credit cards, but I'm talking about any form of credit that has a limit on it. If you're going to have it right to the limit, that's going to have a bearing on your credit history, and it's a fairly substantial amount. So ideally, you want to keep your debt indebtedness no more than 35% of your limit. So if you have a credit card with a limit of $1,000, ideally, you don't want your balance to be any more than $350. If you have a limit of $1,000 and you borrow $1,000, then you're running everything right to the max, and that could be an indicator to other people who are looking at your credit and whether they're going to lend to you or not, that you're a bit of a higher risk, because they want to know why you're running everything to the limit. Are you relying on credit for the wrong reasons? So if you keep your indebtedness 35% or low, then you're going to that's going to help create a very good credit score. Do not request credit too often, and that's another one. I mean, there are times when you're going to perhaps be doing some credit inquiries in a short period of time, perhaps when you're making a major purchase like a home or a car. But if you're seeking credit from a lot of different credit card companies, they're looking at your credit, and that's going to have a bearing on your credit rating. And I've always had the question, anytime I've ever done anything about credit, your credit rating, your credit score, everyone always wants to know why that has a bearing, that do not request credit too often. So when you're a credit seeker, there has to be a reason why you're seeking credit, because overall you do not need to have any more than one credit card. So if you're seeking credit with a lot of different companies in a very short period of time, there's a risk. So everything's based on risk. Anytime anyone is looking at lending you money, they want to know if they're going to get their money back, and they want to know what the risk is. So if you've searched out credit from, say, 5 different credit card companies in one day, and all of those credit card companies gave you a credit card and you have the ability to borrow up to whatever limit they've approved you at, then you're a risk. Same with if you're searching for cars. You want to be careful of how many credit checks are being done on you before you go make that purchase. Because overall, if you have a good credit rating, they should not have to do any more than 1 or 2 credit checks on you. You should be able to get a good interest rate if you have a good credit history. So you don't want to be doing it too often. There is no cut and dry answer as to how many, but if you're constantly seeking credit often, then it's going to have a bearing. Ways to improve it is repay your debt quickly. So if you've taken on some debt, try to pay it back quickly as opposed to dragging it out over a long period of time. And paying it quickly will show good credit history, good usage of credit, being responsible, and that will keep your credit score in good standing and improve it over time. Build a strong credit history. A lot of that's what we've talked about. Building a strong credit history means that you have a lot of advantages compared to not building a strong one. And we're going to talk about that as to why you want to improve it in just a few moments. And as I just discussed with giving you that website, check your credit file before making a large purchase. We recommend that everyone check their credit file at least once a year. Check it in January. Pick the beginning of the year as the day that you're going to check your credit file once a year. And definitely before you're making a large purchase, because when you're going to make a large purchase, that's pretty exciting. Large purchases tend to be buying a home, buying a car, and you don't want any surprises when you go to make that purchase. So checking your file, just make sure that everything is as it's supposed to be, that your personal information is accurate, that if you have 1 credit card or 2 credit cards, that they're both reporting, and that there's nothing reporting in your credit that doesn't belong to you. And sometimes that does happen. So knowing that ahead of time will help you, give you time before you make that major purchase to correct any inaccuracies that are on your credit file. And through the Equifax website that we just showed you, if there is an inaccuracy, there is a process that you can go through to fix that inaccuracy. But sometimes inaccuracies take time to fix. And if you're making a large purchase, you want to make sure that's all taken care of before you do so. So why do you want to have a good credit score? Why do you want to have good credit history? Lots of advantages to having a good credit rating, and you want to because a lot of times because of those major purchases. So especially if you're in the military and you're transferring around from base to base, and you have a very short period of time to potentially buy a home from one base to the next, you want to make sure that you can be approved for your mortgage. And so having a good credit history and credit score will help in that process. And it could be just for a loan even, if you're looking at buying a car, or you're looking at maybe obtaining a loan to purchase some land, or maybe you're looking to do upgrades in your home, or maybe you're looking to amalgamate all your debts together, you're looking for a loan. You want to have a good credit rating and credit score so that you can be approved. You will be getting preferred interest rates on future credit products if you have a good credit score. If you don't have a good credit score, you're going to pay high interest rates. And overall, that does not help you be financially healthy or financially secure if you're going to be paying high interest rates. There's no doubt about it that we do have to pay interest rates when we're borrowing money. That's how those people make money, is that they want to make a profit. So they are going to charge you interest rates, but there's low and high. And paying higher just takes you longer to achieve your future goals. So having that helps you achieve your goals, long-term, short-term, whether it is going back to school, buying a home, buying a car, whatever it is, saving for the future. You want to be able to retire. So if you're paying high interest rates, you're going to be paying it for a longer period of time, costing you more money, and then it makes it harder to achieve all of your goals, short, medium, long. And you also can appear responsible to potential employers. So some employers will check your credit history, and when they check your credit history, it could be a showstopper for potential employers to hire you if there's some concerns with your credit. And I know in some cases, I don't know if this happens all the time, but I had a client recently who was looking to join the military. She was the spouse of a military member, and she wanted to join, and she had a problem with her credit file, and they were holding her job possibility until she sorted that out. So some employers will, some not all of them, but if you have a good credit score, it shows responsibility, and you appear responsible to those employers. Same with rent. Sometimes if you're going to rent an apartment, they will check your credit. So if they're checking your credit and they see some concerns there, they could potentially deny your application. So those are some of the reasons why having a good credit score is important and why you want to build on it to help achieve your goals and pay as little as possible. The more money you have in your pocket, the more that you can save for the future and save for the things that you want and reach all those milestones throughout your life. So the next slide is just actually the last one, and we're going to go into about credit rating and how things look on your credit file. So we've given you the website. Equifax is the one I showed you, and TransUnion is the other one. And we don't know who reports to who. So all banks have agreements, and credit companies have agreements with either Equifax and or TransUnion, and they report to one or the other or both. So it's a good idea to check both credit companies to see what your credit rating looks like. And they change all the time. So say you bank with CIBC, they could have a relationship with Equifax, and in 5 years their contract could be up and they could change and go with TransUnion. They have to pay to report, and they have to pay to obtain. So there's a cost associated with it with these credit card companies. So, and creditors. So some of the high interest rate ones, low-end companies, they may not even report to the credit bureaus. So when you get your credit report, you're going to see on the right-hand side here, you're going to see R for revolving and I for installment. And then you're going to give a number from 0 to 9. So if you have a credit card, it's going to show as R. And R means revolving, and revolving means you have the ability to reuse it over and over again. So if you use your credit card and you pay it, then you can use it again and pay it and use it again and pay it. That's revolving. And credit cards and lines of credits will have that ability. Then you'll have an I for installment. So say you have a car loan. I is for you borrowed a particular amount. Say $20,000, you're going to pay it back over 5 years at whatever it is per month. That's called an installment, and it's a loan, so you can't keep borrowing it. So as you pay down your loan, you can't keep borrowing back that money. It ends at a certain point. So you take out a car loan potentially for 5 years. At the end of the 5 years, that loan is finished, and you're done paying your loan. Same with student loans, same with mortgages. They're called installments. So that's how you're going to see it on your credit report. You're going to see R for revolving and I for a car loan. And then you're going to see a rating from 0 to 9. 0 means no payment history, so you may just have established it. So you maybe just ordered a credit card and it's just been reporting for a month. It's just going to report as R0 until you start using it and paying it. And then 1 is the best. So if you may have heard the saying, you have an R1 rating. R1 rating means you have the best. It means you're paying everything on time, you're paying as agreed according to the contract, and everything is up to date. There are no late payments. Then you have an R2. So you had a little hiccup and you forgot to make your payments potentially, which can happen. Or you just couldn't pay it for whatever reason. Now you have an R2 rating, which means you're 30 days behind in making your payments. And instantly that's going to have an effect on your credit score and your credit rating overall. Then it goes through. So R3 means you're outstanding for 60 days and so on. And then you'll get to an R9, which means it's the worst. So you'll hear sometimes I have an R9 rating, which means you have not paid your credit cards in some time, or your debt, you've missed a lot of payments. And every credit company will rate this according to their own terms and conditions. So some people will, after 3 to 4 months of not receiving payments, they may go, we can't collect anymore, the person's not paying, so they may mark it as an R9 rating. It also means that R9 if you enter into bankruptcy proceedings. So if you enter into bankruptcy proceedings, then your credit rating will automatically go to an R9, even if it was an R1 before you went bankrupt. Bankruptcy proceedings is a whole other type of course, so we're not going to go too much into that today. R7 is another one I'll point out, and that could be that you're entering into some type of debt management program with a debt management company. You could be paying everything on time and everything is good, but there's something just not good in that you can't make those payments anymore in other areas of your financial life are suffering. So you could enter into a debt management program, and that will automatically send your ratings to an R7. That whole area about credit bankruptcies and all that kind of stuff, like I said, that's a different presentation. We won't go into that too much. But this is how your credit rating is comprised. The one that's not there is an O. Like we have R and I, but there's also O, and that's your credit. That's your cell phone company. So if you look up your credit rating, you have a cell phone. 99% chance that cell phone company is reporting to the credit bureau, and they'll have it as an O. An O1 meaning you're all up to date, everything is good, or it could be an O2. You haven't made your cell phone payments perhaps in 30 days. So that's the end of the presentation for credit and debt management and payday loans, and some of the ways to avoid payday loans and getting into credit problems and debt problems overall. So that's the end of the presentation, and just want to say thank you very much for participating, listening. Hopefully you've learned some things. If you have any other further questions on any base, certainly get in touch with your SISIP financial counselor on any of this, and we can certainly help you. The FCAC website, www.fcac.gc.ca, wealth of information on all kinds of different things about finances. It's really, really good. Lots of videos on there and lots of case studies.
And Denise, if anybody has any questions, can they pop you an email?
Yep, email.
And then you can forward them on to the most local local area of resource for them?
Absolutely. So that's my email address. Yep. And SISIP.com, if you go on there as well, and you link into any of the bases that you want to get in touch with, they should have a contact name and number on there as well. But I can certainly get you in touch with anybody.
Super, wonderful. Thank you very much. I really appreciate all this great information, Denise.
Okay. Thank you very much.